Welcome to Explain the Charts, where today we are analyzing the New Zealand dollar against the US dollar on this Monday, March 23, 2026. The market sentiment is currently dominated by extreme caution as geopolitical tensions in the Middle East escalate, particularly around the Strait of Hormuz. This uncertainty has triggered a flight to safety, significantly boosting the US dollar as a safe haven asset while pressuring riskier currencies like the Kiwi. Adding to the downward pressure, Fitch recently downgraded New Zealand's economic outlook to negative, citing fundamental concerns about growth. Recent data also revealed that New Zealand's fourth quarter GDP grew by only 0.2%, missing the 0.4% estimate. Despite this, the Kiwi showed some initial resilience before the broader market volatility took hold of the price action. Energy supply chains are under a microscope as Brent crude oil climbs above $100 per barrel, sparking global stagflation fears. In the cryptocurrency space, Bitcoin has dropped below $69,000, mirroring the risk-off sentiment seen across all financial markets. The New Zealand trade deficit narrowed to $257 million in February, which was a rare bright spot compared to expectations. However, this was not enough to offset the hawkish Federal Reserve policy, which signals only a single rate cut for the entirety of 2026. Current reports suggest that the NZDUSD pair is struggling to maintain any footing above the 0.5850 level. Analysts are keeping a very close eye on the 200-period simple moving average, which is proving to be a formidable barrier. Technical sentiment is heavily bearish as the pair trades below both its short-term and medium-term moving averages. If the current safe haven demand persists, the US dollar is likely to continue its dominance throughout the trading week. Traders should also be aware of upcoming remarks from the RBNZ Governor, which could provide further volatility in the next few hours. For now, the overarching theme is one of caution and downside risk for the New Zealand dollar. We need to look at how these global events are manifesting directly on the price charts to plan our next moves. Let us start by examining the daily chart to understand the long-term trend and major structural levels. Looking at the daily chart for NZDUSD, we can see a clear struggle between the bulls and bears over the last several months. The pair recently saw a rejection near the 0.5870 region, which aligns with significant historical resistance. This level is crucial because it represents a ceiling where sellers have repeatedly entered the market to defend the US dollar strength. We are currently trading around the 0.5830 area, which puts us in a precarious position relative to recent lows. The 52-week range for this asset is quite wide, spanning from 0.5486 to 0.6120. This tells us that while we are currently suppressed, the asset has a history of high-amplitude swings that traders can exploit. The declining 20-day exponential moving average is a clear indicator that the short-term momentum is firmly in the hands of the bears. Support is currently identified at 0.5770, which has served as a floor during previous bouts of selling. If the price breaks below this 0.5770 level, we could see a rapid acceleration towards 0.5711. On the flip side, the daily RSI is hovering near 40, suggesting that we are approaching oversold conditions, but not quite there yet. A bullish reversal would require a daily close above 0.5890 to shift the market structure significantly. The volume data shows that transactions remained relatively steady during the recent decline, indicating a consistent selling pressure. We can also see a correlation between the Fitch downgrade news and the sharp rejection at the moving average clusters. Long-term investors might view these dips as buying opportunities if the major 0.57 support level holds. However, for the short term, the trend is clearly bearish until we see a change in the macroeconomic landscape. It is important to remember that technical levels often act as magnets during times of high fundamental uncertainty. Switching over to the 1-hour chart, we can gain a better perspective on the volatility that occurred during early March. Notice the price action between March 2nd and March 5th, where we saw a series of lower highs and lower lows. This period was characterized by the market processing the disappointing GDP data and the firm stance of the Federal Reserve. The hourly candles show several spikes towards 0.5950 that were met with immediate selling volume. This demonstrates that institutional players are using any minor rallies to offload their long positions. The 0.5900 level acted as a psychological barrier that the bulls failed to reclaim during this window. We also see a significant drop on March 3rd where the price fell from 0.5940 down to nearly 0.5880. This 100 pip move in a single day highlights the sensitivity of the Kiwi to incoming economic data. Correlating this with the news, the lack of positive catalysts during this time allowed the bearish momentum to solidify. The average true range during these sessions was elevated, signaling that intraday traders had plenty of movement to work with. Looking at the transaction counts, we see a peak in activity at the European and US market open crossover. The hourly VWP remained above the price for most of these sessions, reinforcing the bearish bias for day traders. Small corrective rallies were often short-lived, rarely lasting more than a few hours before the primary trend resumed. This timeframe confirms that the 0.59 zone is now a major resistance area to watch for future sessions. Understanding these shorter-term cycles is key to identifying entry and exit points in a trending market. Zooming in further to the 15-minute chart, we can analyze the most recent price movements leading up to today. Over the last few days, specifically between March 18th and March 22nd, the price has been consolidating in a tight range. We see a notable drop on March 18th, where the pair slid from the 0.586 level down to 0.578. This intraday crash occurred as news of the Middle East conflict intensity first hit the wires. Following that sharp decline, the market has attempted to build a base around 0.5800. The price action on March 19th and 20th shows a series of small, indecisive candles as the market waits for a new catalyst. Resistance has formed locally at 0.5840, and every attempt to break above it has been rejected. The narrowing of the Bollinger Bands on this time frame suggests that a major breakout is likely approaching very soon. If the breakout occurs to the upside, we will be looking for a test of the 0.587 level we discussed on the daily chart. If the breakout is to the downside, the previous low of 0.578 will be our first target for short positions. This 15-minute view is where we can see the battle for liquidity at the micro level. Traders should watch the volume bars here. A spike in volume during a breakout usually confirms the validity of the move. The current consolidation suggests that the news of the trade deficit narrowing has provided a temporary floor. However, the safe haven flows into the US dollar are still the primary driver for the overall direction. Keep a close eye on these intraday levels as they will dictate the momentum for the London and New York sessions. Scalpers should be particularly careful of fakeouts near the 0.5800 psychological handle. To wrap everything up, the NZDUSD pair is currently in a strong bearish trend driven by geopolitical fear and domestic economic weakness. The key resistance levels to watch are 0.5870 and 0.5890 on any relief rallies. On the downside, our primary support levels are 0.5770 followed by the critical 0.5711 floor. I believe a continuation of the bearish trend is high, likely at a 70% probability, given the current strength of the US dollar. A bullish scenario only becomes likely if we see an immediate de-escalation in the Middle East and a reclaim of 0.5900. Watch for the RBNZ Governor's speech later today, as any hawkish surprise could trigger a quick squeeze of the current short positions. In the long term, the asset remains pressured until the global inflationary outlook stabilizes and energy prices cool down. Traders should stay unbiased and let the price confirm the breaks of these key levels before committing to large positions. Look for a daily close above the 20-day EMA as the first sign that the bearish pressure is truly starting to fade. Always use proper risk management and stop losses, especially during times of global geopolitical uncertainty. We will continue to monitor these developments and update you as the chart patterns evolve. Thank you for watching. Explain the charts and make sure to subscribe for more in-depth analysis. Please note that this video is for educational purposes only and is not financial advice. Always conduct your own thorough research and consult with a professional before making any investment decisions. Trading Forex involves significant risk to your capital and should be approached with a clear strategy.